First off, I'd like to wish everyone a very happy new year. And it's certainly looking as though we're coming into 2024 more prosperous because of the Federal Reserve. And in terms of what Jerome Powell, the Federal Reserve Chairman, has been talking about. So the kind of pivot that he made back in December from being higher for longer, only 2 to 3 weeks before that, has now been, we will look to reduce interest rates in 2024. Markets loved it. All asset classes are on fire in terms of the risk is back on the table, and whether it's bonds, commodities, stocks, and gold, all asset classes are moving because of this. Why has he done this? Why has this pivot happened? Either it's through data has seen that the economy is slowing a lot quicker than they expected, and also with inflation. But we think it's another factor. If you go back a couple of years, you remember that he talked about inflation being transitory, and therefore interest rates didn't have to rise. He got that completely wrong, and obviously raised interest rates very aggressively throughout the last 12 months. So I think going into 2024, we think that there could be an interest rate cut as early as the first quarter, maybe around March, because I think the Federal Reserve will want to be ahead of the markets, or ahead of inflation falling, and not be kind of blamed again for being a bit slow to bring interest rates down. So that's the good news. That's what markets are liking, and obviously that Goldilocks scenario of still that the economy is resilient, the consumer is resilient, and the inflation falling, interest rates falling, adds up to a very healthy stock market in the US. And of course, we've got elections in the US next year as well, and typically markets do well prior to a US election. So all in all, Federal Reserve has set the mark for other central banks, and we think the ECB, the European Central Bank, and the Bank of England will follow suit, probably second quarter of 2024. Obviously, it's never all going to be blue sky, and when something's too good to be true, it means it's probably not. So let's look at some of the risks out there. Obviously, China remains a risk in terms of them not doing a stimulus and falling to deflation, maybe more problems within the property market, which would hurt global markets, but in particular emerging market inflows. Geopolitical events, whilst we've managed to kind of go through the more recent ones, there's still a lot of geopolitical events on the horizon, and of course climate change is changing a lot of things that happen around the world, and that the worry there would be more towards food. So anything that moves commodity prices higher, food prices higher, a more resilient US than we expect could have that inflation being a little bit more stickier than markets expect. And obviously our view of interest rates falling in the first quarter would again get delayed, and the market's not really pricing that in at the moment. So big pivot, great for markets, great for emerging markets, and that's the call, is that markets are going to enjoy a very good first half.